Here is something that confuses almost every beginner when they first look at an options chain. Apple is trading at $182.50. A call option with a strike of $185 costs $3.20. But a call option on NVIDIA, a stock trading at the same price, costs $12.50 for the same structure. Same stock price, same strike distance, same expiry. Completely different premium. Why? The answer is not random. Every single cent of an options price is explained by a small set of factors that interact in predictable ways. This video breaks down exactly what determines the premium you pay, so that you can look at any options price and immediately understand why it costs what it costs. Before we get into what drives the price, you need to know that every option premium is made up of exactly two components. The first is intrinsic value. This is the amount the option is already worth if you exercised it right now. It is the concrete, measurable part of the price, based entirely on where the stock is relative to the strike. The second is time value. This is the extra amount the market charges on top of intrinsic value, reflecting the possibility that the stock could move further in your favor before expiry. Every option premium equals intrinsic value plus time value. Out-of-the-money options have zero intrinsic value. Their entire premium is time value. In-the-money options have both. Understanding this split is the foundation for understanding everything else about options pricing. Intrinsic value is simple. It is the profit you would lock in if you exercise the option right now. For a call, intrinsic value equals stock price minus strike price, when that result is positive. Apple is at $185. You hold a call with a strike of $180. Intrinsic value, $5 per share. The option is worth at least $5 because you could exercise immediately and profit by 5. For a put, intrinsic value equals strike price minus stock price, when positive. You hold a put with a strike of $190 on Apple at $185. Intrinsic value, $5. If the result is negative or zero, the stock is below the call strike or above the put strike. Intrinsic value is 0. You cannot have negative intrinsic value. The option just has none. Time value is the more interesting component and the one that requires more explanation. Time value exists because the future is uncertain. Even if an option has 0 intrinsic value right now, the stock could move in your favor before expiry. The market prices that possibility. The more time remaining on the contract, the more opportunity for the stock to move, so the higher the time value. A 90-day option has more time value than a 30-day option on the same stock at the same strike, because there is more runway for something to happen. Time value also depends on how volatile the stock is expected to be. A stock expected to move dramatically has higher time value than a stable, slow-moving stock, because more movement means more chance the option ends up profitable. Time value is, at its core, the price of possibility. The first factor that drives premium is the relationship between the stock price and the strike price, which determines intrinsic value directly. As Apple rises, call option premiums rise. As Apple falls, put option premiums rise. This is direct and intuitive. But what is less obvious is how sensitive an option is to this movement. An in-the-money option moves almost dollar for dollar with the stock. It has high intrinsic value and changes as the stock moves. An out-of-the-money option is far less sensitive. It mostly consists of time value and only gains real value when the stock makes a significant move toward or past the strike. This sensitivity is measured by a Greek called delta, but we will cover that in the Greek's video. For now, just understand, the further in the money an option is, the more directly it tracks the stock price. The second factor is time to expiry. More time equals higher premium. Always, everything else being equal. A 30-day Apple call at the 185 strike might cost $3.20. A 90-day call at the same strike might cost $7. A 1-year call might cost $15. The additional cost is pure time value, the market charging you for the extra runway. As time passes, time value erodes. This erosion is not linear. In the first half of an option's life, decay is relatively slow. In the final few weeks, it accelerates dramatically. By the last few days before expiry, time value can collapse almost entirely in 24 hours. This is the time decay concept from video 3. Now you understand the pricing mechanism behind it. Time value is literally a premium the market charges for the privilege of having more time. The third factor, and the one that explains the NVIDIA versus Apple example from the opening, is implied volatility. Implied volatility is the market's expectation of how much a stock will move over a given period. It is expressed as an annualized percentage. If Apple has an implied volatility of 25%, the market expects Apple to move roughly 25% over the next year and prices options accordingly. NVIDIA might have an implied volatility of 50%. The market expects it to move far more. Options on NVIDIA are more expensive not because the stock is at a different price, but because the market expects bigger moves. Higher expected movement means more chance any given option ends up profitable, so the market charges a higher premium. Implied volatility is the single biggest driver of time value in an options price. Let us make implied volatility concrete. Imagine two identical houses on the same street, both worth $500,000. You want to buy insurance on each. House A is in a quiet suburb. Historically, property prices there barely move. House B is next to a proposed development zone. Prices could double or crash depending on the decision. The insurance on House B costs far more, even though the house is worth the same amount today. The insurer is pricing in the possibility of a large move. That is exactly what implied volatility does for options. A stable stock like a utility company has low implied volatility. Its options are cheap because the market does not expect large moves. A high-growth technology stock or a biotech company awaiting trial results has high implied volatility. Its options are expensive because large moves are expected and possible. Same stock price can mean very different premium. One of the most predictable and important patterns in options pricing is what happens around earnings announcements. When a company is about to report quarterly earnings, implied volatility spikes. The market knows a big move is possible. Results could beat expectations or miss badly, and it prices that uncertainty into every option. A stock that normally costs $3 for a 30-day at-the-money call might cost $6 or $7 in the week before earnings. After the announcement, implied volatility collapses immediately, regardless of which direction the stock moved. This collapse is called the volatility crush, and it is one of the most important dynamics in all of options trading. Buying options just before earnings is expensive for this reason. The move needs to be large enough not just to exceed the strike, but to exceed the inflated premium you paid for the uncertainty. Let us put the two components together using a real Apple example. Apple is trading at $182.50. You are looking at a call with a $180 strike, expiring in 30 days. The premium is $6.50 per share. Breakdown. Intrinsic value is $2.50. Apple is $2.50 above the strike, so the option is already worth $2.50 if exercised now. Time value is $4. The remaining premium is the market pricing in 30 more days of potential movement and the current level of implied volatility. Total, $6.50. Now move to the $185 strike, out of the money. Premium is $3.20. Intrinsic value, 0. Apple has not reached the strike yet. Time value, $3.20. The entire premium is possibility. Here is why NVIDIA options cost more than Apple options even when both stocks are at the same price. Over the past year, NVIDIA has regularly moved 5 to 10% in a single day. Earnings beats, AI announcements, supply chain updates. Apple moves 1 to 3% on similar events. The market has learned to expect larger moves from NVIDIA, and it prices that expectation into options via implied volatility. If NVIDIA has an implied volatility of 55% and Apple has 22%, NVIDIA options are more than double the price. Not because NVIDIA is riskier in some vague sense, but because the market has a specific, quantified expectation of how much it will move. This is why you cannot compare option prices across different stocks without also looking at implied volatility. The premium is always relative to expected movement. The four main factors that drive every option's premium, summarized. Factor 1. Intrinsic value, determined entirely by where the stock price is relative to the strike. Higher for in-the-money options, 0 for out-of-the-money. Factor 2. Time to expiry. More time equals higher premium, all else equal. Time value decays as expiry approaches, accelerating in the final weeks. Factor 3. Implied volatility, the market's expectation of future movement. Higher volatility means higher premiums across all strikes and expiries. Factor 4. The direction of the underlying. As the stock moves toward your strike, the option gains value. Away from your strike, it loses. These 4 factors interact constantly. A stock rising toward your call strike adds intrinsic value, but falling implied volatility can partially offset that gain. Understanding all 4 together is what separates a trader who understands their position from one who simply hopes. What does all this mean for you as an option buyer? 3 practical implications. First, you are always paying for 2 things: the current value of the option and the time and volatility premium on top. The premium you pay must be earned back by the stock move before you profit. Second, time is working against you from the moment you enter. Every day that passes, the time value component shrinks. Even if the stock does nothing, your option is worth less tomorrow than today. Third, buying options when implied volatility is high, particularly just before earnings, means paying an inflated premium that can collapse even if the stock moves in your direction. The stock gaps up 5% after earnings, but the option barely moves in value because the volatility crush offset the directional gain. As a buyer, you want to buy when implied volatility is relatively low and sell when it is relatively high. That principle will appear in every strategy video in this series. There is another side to every options trade: the seller. When you buy an option and pay the premium, someone on the other side of that trade is collecting it. The seller has the opposite exposure. They benefit from time decay, and they are hurt when the stock makes a large move against their position. Options selling is a legitimate and widely used strategy. In fact, most professional options traders spend more time on the selling side than the buying side. The premium is income to them. Time decay is profit to them. We will cover options selling in detail, including the most popular income strategies, later in this series. For now, just understand that the pricing dynamics you just learned apply equally to both sides. The buyer and seller both need to understand what the premium represents. Here is what you now know. 1. Every option premium equals intrinsic value plus time value. 2. Intrinsic value is the profit you could lock in by exercising right now. 0 for out-of-the-money options. 3. Time value is the price of possibility. It erodes every day and collapses fastest near expiry. 4. The 4 main factors driving premium are stock price relative to strike, time to expiry, implied volatility, and underlying direction. 5. Implied volatility is the biggest driver of time value. High volatility stocks have expensive options. Low volatility stocks have cheap ones. 6. As a buyer, time decay and high implied volatility work against you. Enter when volatility is relatively low and give yourself enough time. That is video 4 complete. The next video covers how to read an options chain, the live table of every available strike and expiry for a stock, so you can translate everything you have learned into actual trade selection.